Parks Capital, where education plus investing equals success.
Hi, I'm your portfolio manager, Rajiv Dixit, and welcome to the market outlook for the fourth quarter of 2022. In our last outlook in July, I left you with some key points about the markets. Let's recap them first. First, the US equity and bond markets were in a major correction, with the S&P 500 down 21% and the bonds down 11% at the time. Second, we highlighted that the cause of this correction was the problem of inflation and the Federal Reserve's inability to control it at the right time. Third, we also pointed out that because of the fact that we have cash in our portfolios due to the sales we did in January, and that we are all long-term investors, this major correction should be viewed more as an opportunity rather than a calamity. And last but not the least, we believed at the time that the worst case scenario of the inflation problem has already played out in the second quarter of the year, and thus we are closer to the bottom of this correction than the top. The worst case scenario, of course, being that inflation is at 40-year highs and the Federal Reserve is in panic mode trying to play catch up from last year. So, here we are 3 months later, and it is important to see how this quarter has fared. On the surface, the S&P 500 is now down 24%, and the quarter has been anything but smooth sailing. While there was a relief rally in the month of August, all of the gains from that rally were given up by the market in the dark month of September. But volatility is to be expected at this stage of the correction. What is often lost in the middle of this volatility is the trend of the losses. If we were to break down the yearly loss of 24% and see it on a quarter-over-quarter basis, we will find that the majority of the loss for the year came in the second quarter, when the worst case scenario was being priced into the market. Since then, the losses have been muted in comparison. Additionally, another positive sign for the market in the third quarter was the fact that even though most equity indices retested their lows or got close to their lows from June, major stocks like Amazon, Disney, and others were significantly higher than their June lows. This is also a reversal of trend, as if you recall from last quarter, these stocks were underperforming the major indices by a big margin. The above 2 points, in our opinion, is a very positive sign for the correction. It starts confirming our assumption that the worst case scenario of the problem has been priced into the market in the second quarter, and we are in the late stages of this correction. Late stages of a correction? What does that really mean? Do corrections actually have a set pattern they follow? Do they have a life cycle of their own? Well, these are the questions that we went finding answers to in the past quarter. And what we found was so interesting that I want to share our findings with you in this outlook. It turns out that corrections do have a pattern they follow. We drew a chart of this pattern that I want to share with you. This is what a typical correction looks like. It all starts out with a problem. Usually, at this point, the market is at the state of euphoria. We are excited about the recent uptrend and things are looking good. Our first reaction of the problem is one of denial. We know there is a problem, but we are in denial that this problem will have any significant effect on the financial markets. It will just go away on its own is the general consensus. As this problem starts to become bigger and come into the forefront, market participants move away from the state of denial and start to understand and price in the worst case scenario of the problem. This is when markets start to move down and the correction actually starts to get more aggressive. This is when major losses happen. Think about it. This is when the market participants are readjusting their portfolio to adjust for the potential worst case. Next is the stage when events unfold, and unfortunately we see the real impact of this problem and the worst case scenario starts to come into play. But as you will see in this chart, by the time the worst case scenario happens, the majority of the losses have already occurred. Why? Because by this time, most market participants have already adjusted their portfolio, or in other words, have priced in the worst case scenario. Next comes the bottoming stage, or the chop stage as I like to call it. After the worst case scenario has occurred, we move into the bottoming stage of the correction. In this stage, there are primarily two schools of thought conflicting with each other. The first school of thought, or let's call them the bulls, are market participants who are questioning if the market actually overshot given the worst case scenario. These participants are thinking, hey, maybe this wasn't as bad as the market is reacting. Is this a buying opportunity? Maybe we should start to deploy some cash here and take advantage of the oversold markets. While the other school of thought, or the bears, are still concerned with one question. What else can go wrong that we haven't yet priced into the market? Should we sell more to raise more cash? This back and forth between the bears and the bulls of the market creates the chop and brings in the increased day-to-day volatility in the market. It's important to point out here that in most cases, the actual problem has not been resolved yet in the bottoming stage. The market doesn't actually care about the fact the problem is solved. All we care about is that the worst case scenario is priced into the market. So how do we know if this is actually true? Well, don't take my word for it. Let's quickly go back and put the past two major corrections to test. The first one, of course, is the one we recently went through, the pandemic in the year 2020. We had a problem in December-January timeframe. We all knew this was a problem, but we were in denial. We believed at the time that this is a China problem and it's not going to come to the United States and affect our markets. But then we slowly started to realize that this is upon us at our shores, and the markets started to readjust the prices based on what they were finding out. By early March, they realized that the worst case scenario of this problem was that the US and global economies could shut down, and that would be devastating. And thus major losses happened while we were recalibrating for the worst case scenario. Once that was done, the problem wasn't over, the pandemic wasn't over, there wasn't even a vaccine anytime in the near horizon. But the worst case scenario was priced into the market by then. And what did the markets do then? They started to chop around for the next 2 to 3 months, and they started to revert back while the problem still existed upon us. Second, let's look at 2008 correction. Mortgage-backed securities was the problem. We were in denial. In October of 2007, we were in absolute denial that this will have any meaningful impact on our economy. But then, by the end of 2007 and the beginning of 2008, we all started to price in the worst case scenario. In that case, the worst case scenario was that one big bank is going to fail and the Federal Reserve is not going to be able to come to the rescue of the too big to fail bank. Well, in September, October of 2008, that is exactly what happened when Lehman went bankrupt. After 3 or 4 months of the market chopped around and formed a bottom. In our current situation, obviously, inflation is the problem. Markets and Federal Reserves were in denial last year that this is a major problem. But then, in first and second quarter, we started to identify the worst case scenario and started to price in that worst case scenario in the second quarter as it started to play out in front of us. This is important to understand because if we understand this life cycle, we can better understand what stage we are in the correction and then accordingly plan our portfolios. It also gets rid of the feeling of cavity where we don't know where we are going from here. It also helps us weed out the noise we hear in the day-to-day nuances of the markets. This quarter, I want to put the question, are we going to have a recession soon in the noise section? By no means am I saying that recessions are not important. Recessions are an important part of an economic cycle and more importantly have a major impact on our day-to-day lives. But that question belongs in the noise section of every long-term investor because a recession is a major lagging economic indicator. By the time a technical recession happens, markets have already priced in the worst case scenario and readjusted. The fact that we are going to have an economic recession or not should not be significant to an investor's portfolio strategy for that reason, because it's merely a byproduct of the problem and its worst case scenario coming to fruition. I'm looking forward to talking more about this with all of you. Before I leave you, let's take a quick look at the charts and discuss the forward-looking strategy of your portfolio. This is a monthly chart of the small cap index. We've been looking at this one for a while. Last time we talked in July, this chart was testing this support line we drew back in January. In the past quarter, it has successfully tested this support and continued to hold it. This, in our opinion, is a very positive technical sign. Our strategy remains the same. As this line gets successfully tested and market gains strength, we plan to slowly put the cash we raised in January back to work in the markets. We are not trying to catch the lows by any means, as from the long-term investor's point of view, that is not significant. What we are doing is slowly get ready for the next phase of this correction life cycle. Of course, if this line was to meaningfully break, we would be readjusting the portfolio again and raising more cash to wait for the next support line. I want to remind you again, the purpose of this update is not to predict the future. No one can do that. The purpose of this update is to inform you of what we are seeing and how we are preparing for it. Of course, if things were to change between now and the next update in 3 months, we will be reporting about those changes and how we adapted to them in the next update or during our next conversation. We cannot close this piece without highlighting one obvious fact. The above views of the market and the narration of the events is a general view. You know that every portfolio in Parks Capital is managed based on who you are, and thus they all look a bit different based on your risk tolerance and your individual goals. Please keep that in mind. We're looking forward to talking with each of you in your quarterly reviews. Remember, education plus investing equals success.
Here at Parks Capital, we strongly believe that a successful investor is an educated investor. For this purpose, we've created our own YouTube channel. Education plus investing equals success.